Ask your sponsors about what happens when the unexpected happens. How are you positioned? Because you don't want their default to go to is to, I guess we got to do a capital call. And that's not to say that every sponsor out there doing a capital call is a bad operator. They are not.
All right, here we go. It's another episode today. And today I have the pleasure of talking to Stewart Heath. How you doing today?
I'm doing great. Thank you so much for having me.
Oh, yeah. Thank you for coming. I appreciate it. Again, it's a pleasure. Let's just go ahead and just start with a bio and just give the audience members a little background of who you are, what you do, and, any other additional details that you feel like the audience members should know.
Great. Well, thanks again for the opportunity. It's an honor to be on your show, and thank you for your service. My name is Stewart Heath. I am a certified public accountant. I've been one for more years than I'm going to admit here, but it's a really long time. I was born in Alabama, raised mostly in Tennessee, and have sort of stayed focused on that geography and practiced for many, many years as a CPA, saw many clients really pull themselves out of some pretty serious financial holes by pursuing a strategy of real estate. And as you know, there are many different kinds of things you can do with real estate. You can buy and hold and rent. You can do fix and flips and rent, or fix and flips and sell. You can syndicate the real estate. You can do new real estate development. And so I've just had a number of clients, and it sort of took me sort of going through a bit of a rough time before I tried it myself. I was busy trying to build an accounting practice, and sort of late one night in the middle of tax season going, I'm not doing anything. I was making really good money, but I realized working myself to death and not really building any value. And to have value, that involves assets and building an organization or working on assets. So I sort of realized that, and then it dawned on me that why don't I do what my clients are doing? I mean, I'm advising them. I know exactly what they're doing. I know how to do it. And so started pursuing real estate in many different forms. Back in about the year 2000, 2001, started buying duplexes, then condos, then got into construction and development. Didn't fare so well during the last financial crisis, as they like to refer to it, the 2008, 2009 period. But that never deterred me from real estate. Those are just things you have to be prepared for. And so spent a few years as a CFO in different organizations. And then in 2017, left full-time employment to start my own firm again as a fractional CFO for companies, and did that. And still the real estate bug is just there. I was making good money, but wasn't building any value. And so started to pursue, I wanted to do commercial real estate this time. I'd had many residential rentals. I think at one point we had 200 units at one time. And I like to say that's the nearest definition of hell I can think of is 200 residential units management. So because, people just don't always act like you think they should. So commercial is a little bit different world. You're dealing with mainly business leaders or organizational leaders for the most part. I enjoy that part. And so, but to do that, those are much bigger assets. And so I had to do syndications. I had to raise money from other people. And I knew how that worked. I had worked with many different firms on that. I'd participated in the structuring of those deals, and I knew what the legal documents were and how that worked. It was just, I had never raised capital on my own. So the first deal we did, we raised about $1.2 million from people that I'd known mainly for 30 years. And then, well, great. That was easy, right? It's always easy after you complete it. And then later in 22, we did another deal, a big storage facility down in Huntsville. And so every time we do a deal, we're adding new investors to it. Hopefully, our investors refer other people, which happens a lot. But we're very active, social media, doing podcasts. Trying to get to make contacts with people and meet new investors, and pretty much what we do every day. We have a deal going on right now that we'll close out in about 2 weeks. So
Okay.
That's
right.
who I am. That's my short version of the history.
Okay. Awesome. I think you talked about you working a corporate job. You even stated you was making some good money, but it was at a point where you felt like you wasn't scaling. You wasn't hitting the mark as far as where your potential was. When you started to hit that mark and you saw real estate through your clients, you saw that they was doing it, they was building their wealth through real estate. And you went into the residential space and then eventually moved into the commercial space.
Yeah.
You stated something in regards to, you said you had 200 units at one point, residential,
Mm-hmm.
and you moved into the commercial space.
Yeah.
What made you decide? I think you hit it a little bit, but can you elaborate more on what was the ultimate decision to make you go from residential to the commercial side of things?
Well, to be clear, there's nothing wrong with the residential space. It is, frankly, the leading asset class of real estate, and really one of the leading asset classes of all asset types. I mean, residential, we're a real estate based economy. People don't like to think that. They like to think that, with, since 2000 and the advent of the internet and tech companies and stuff, they like to think that tech drives the world. Right. And it's a big part, but we all have to live somewhere. We're physical beings and we got to exist somewhere. And so multifamily and home sales are the leading asset classes of our economy. As housing goes, usually the economy goes. And beyond that, if you put your finger on a map where there are some residential units, then you can go concentric circles out from there, and then you get all different forms of commercial, shopping centers, restaurants, office buildings, all of that. But multifamily tends to be much more consistent. I personally wanted to go more commercial for a few reasons. It was sort of a lifestyle choice. I just enjoyed working with, sort of organizations rather than individuals. I mean, people are messy. They sign a 1-year lease and then, and then they have personal problems. And this is true in commercial as well as residential. When your tenants have problems, you got problems. So I can choose to build up a portfolio of another 200 residential units and then have a potential 200 problems, or you go commercial and you have less relationships to deal with. So that's how I'm wired. Again, I'm a CPA and I'm kind of used to dealing with businesses as organizations, not necessarily individuals. So it's a lifetime change. Again, it's an awesome asset class. And I'm certain that I will do some residential again someday. I'm actually looking at a piece of excess land we have today. I'm thinking, yeah, housing's probably the best thing to go there. So we're probably going there. The other side of that is generally in commercial, your returns are going to be quite a bit higher. The risk is a little bit higher. And multifamily, if you look at your average multifamily deal, as you turn, your annual rates of return will be, in the high teens, maybe mid-teens on an annualized basis. Commercial, you're typically going to be in the low 20s. Now, it takes a little longer for those things to develop, but for the most part, you're going to make a little bit more money. It's probably good to be a little bit more diversified because multifamily, or build to rent housing, those type of things are 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 going to be more healthy. They will go through less cycles, is what I'm trying to say. They'll stay stabilized longer. Now, for that matter, we only focus on stabilized properties. We're not currently doing any development. We're not, which is, again, that's where all the risk is, but it's where the big, 50 and 60% gains are too, is because of all the risk. We only focus on cash flowing, stabilized properties. So,
are these properties located in the Huntsville area, Tennessee, Tennessee and upper Alabama area, or you going outside of those areas too?
We haven't gone outside yet.
Okay.
We do state that our market area is the 840-565 corridor. Mm-hmm. So those refer to two interstates. One of them sort of a southern loop under Nashville. 565 goes through northern Alabama, and we like everything that's in between those. Mm-hmm. There's some small towns in there. Most of those small towns are pumping off of the Nashville and the Huntsville economies. Nashville's booming. Huntsville, a lot of people still don't know about Huntsville. Those are becoming fewer and fewer, but Huntsville's a boom town. Mm-hmm. And it's a nice balance of government and industry investment that's driving that right now. So right now, 3 of our properties are in Huntsville. One is in southern Middle Tennessee in Spring Hill, but we're very high on the southern Middle Tennessee piece as well. It's harder to find deals there currently. So we might have to develop something there.
Yeah, so. Before this podcast started, we was talking about Huntsville, and just I used to live there. I lived in Madison. That's like the higher end of Huntsville. Well, the Huntsville area. They're in the same counties, right? I believe.
Yep. Both are in Madison County. Yeah.
Yeah, Madison was beautiful. I loved it there. It was just great seeing it. And at that time, I was oblivious to what real estate was and what the impact real estate could have had I took the opportunity to do so. But looking back, I'm like, oh man, I think it's still a great opportunity to invest in that area. And Nashville is, of course, booming. But Huntsville, I think, is going to be growing within the next couple of years for sure. There's a lot of tech guys living down there. A lot of I think they have the space program down there. I thought they said they was moving the FBI down there. It's just a lot of 3-letter agencies that's going to be coming down there, and it's just it's the next couple of years. It's definitely going to be a city to watch it, or that area, the outskirts of that area, not just Huntsville itself, but Gadsden, Limestone, all those little small cities that a lot of people don't know about. I think it's going to be a booming market.
Yeah, the deal we're working on and we'll close on in a couple of weeks is in Madison. Mm. I made the mistake of referring to Madison as a suburb of Huntsville, and did I get some heat for that? I mean, 25 years ago, they were two very distinct towns, and now Huntsville actually surrounds Madison. Mm. But still, Madison is its own distinct community, and and they don't necessarily see eye to eye on everything. But it's a very nice town. So
it is. I want to shift into, because we're coming to the end of this year and going into the beginning of next. I would like to ask you, as a CPA, what are some tax strategies that you could, that accredited investors could do in order to maximize their passive income? Can you share your thoughts or anything that you see in the near future?
Well, there's still some opportunity. As we record this, it's December the 2nd. And so you got basically a month left. And I keep referring to the deal that we're closing in a couple of weeks. One of the main motivators of our investors getting in on this one is that we will get a full year of 2023 bonus depreciation this year. And we'll do a cost segregation study to maximize those deductions. But if you're a real estate investor, you need to embrace and use the depreciation allocations. Unfortunately, bonus depreciation is being ticked down. So last year was the last year of 100% bonus. This year, we'll still get 80% bonus depreciation. Next year in 24, it ticks down again. And this all goes back to the 2018 Tax Reform Act done under the Trump administration. And so it's been a big bonus. But as a CPA, I've seen these tax advantages come and go. They love to pass them and then put a sunset on them. And so that they can come in and pass something else and be the heroes again. But so there are advantages you can do. And a lot of it has to do with timing. Now, backing up a step, taxes aside, and taxes are important. I firmly believe that everybody needs their own core foundation of recurring cash flow. And if you don't, depending on where you are, you probably have some sort of recurring cash flow. Maybe it's your job. Jobs come and go. Maybe it's trust income or whatever. But if you need to build that foundation of recurring cash flow, then cash flowing real estate is a great option. There's also dividend stocks, which are an option, which tend to go up and down with the 10-year treasury and things like that. So your principal can fluctuate. Real estate values can go up and down too, but not near like the stock market. But when you're talking about building your core, you're not as worried about fluctuations of the underlying asset. But when you have a basis of recurring cash flow, then you've got the freedom to go out and pursue some of those development opportunities, which also have tax advantages to them. So back to your question, what can you do now, between now and the year end? Get in a deal that you'll get some 2023 bonus depreciation this year. That's one of the things that you can do right now, tax planning. And there are several. This has been a difficult year to do a deal, both from the seller side, who are still wanting to think that interest rates are in the 4% and not realizing what their buyers are having to borrow at. But it's also been, somewhat, people are less liquid than they have been in a couple of years. So it's there's been fewer investors. So anyway, it's been challenging. It's not impossible. So we're closing out our second deal this year. But I think, frankly, a couple of years ago, everybody was all, oh yeah, let's go do new multifamily. Let's do ground up. Let's do fix and flips, and all of that is development related and high risk, high return. I have always been about boring stuff, stabilized cash flow. Not a whole lot to talk about except the great credit quality of the tenants, and it's just cash flow. So, and that's our shtick. That's what we do. And I think there's room in the market for both. There's need for development, absolutely, but there's also a need for a focus on stability and recurring cash flow.
Right. I think with the current market where it's at right now, and then I want to go back to your point in regards to the cost, the cost segregation that you study that you're going to do on your multifamily projects in order for the investors to have the depreciation for 2023. So there's still time for you, for those of you out there, there's still time to save on your taxes when it comes to these projects. You still can invest. You still can do have that depreciation on your taxes. You just got to find a deal, find a good sponsor, and do your proper due diligence and just trust the process. And as long as they're doing that cost segregation, they can get that good depreciation on your taxes for you. With the market where it's at right now, I know a lot of experts are saying, multifamily is it's going to be some big opportunities from here on out, just because of during 2020, for instance, there were some individuals who instead of going to fixed rate, they went with a floating rate. And that floating rate now has become a breaking point for a lot of properties, a lot of multifamily projects out there. And now they're breaking even or not even breaking even on some of their projects. Given the type of market that it is now, do you see the same thing as far as opportunities coming and the multifamily in the multifamily space in 2024? And with those opportunities, are you seeing anything in the area that you're investing in?
I think what you're referring to is sort of the debt wall, as it's starting to be called, as the talking heads are referring to it as. There's a whole bunch. It's in the hundreds of billions of dollars for in 24 and 25 of debts that are coming renewed. Not just floating rates, but also your classic 5-year balloons that are coming due in these years. And so, yes, I see that coming. And the most problematic asset class that they're talking about is, they say office, and they throw all office into one bucket. But it's primarily like central business district, Class A office space. I own 2 office buildings. They're all full, and there's suburban office, there's medical office, there's 6 different subcategories of office. So you've got that one. And frankly, the multifamily ones that are having problems are either development deals, or they're the value add deals, which is, a form of redevelopment. And, you had no choice. People don't put fixed loans on something that you're working on because that's not stabilized yet. And so you had no choice but to float that rate. And so, yeah, a lot of people are struggling with those because the world changed 4 times. A year ago yesterday, I closed on a large self-storage facility, and we got a fixed rate of 5.3. What are rates today? 12 months later, right. 8.25, 9. Right. So it's crazy. So, not quite double, but it's not far from it. Right. So nobody plans for that. So this is not necessarily your sponsor's problem. And frankly, the bankers and slash the lenders are share equal responsibility for that, for whatever problems you're having. But it ends up being the sponsor's problem. The only solution to that is more capital. And unfortunately, so that's why we hear about the capital calls going on. So you asked me about opportunities. In my mind, these opportunities to swoop in and buy a distressed property, which might be a great property and might be stabilized under a different capital structure, but it's distressed because the debt's upside down. Those opportunities are going to be highly regionalized. Frankly, the deal that we're closing right now in Madison is a distressed deal, but it's because the seller's distressed. Has nothing to do with the property. Okay. The seller is from California. They've got issues at other places. This property is perfect. They did a great job with it. But there's, frankly, we waited them out and we got a great price because there weren't a whole lot of other buyers in the market. So there's all kinds of different sources of distress. I don't think there's going to be a lot of, quote, distressed properties in the cities of the Southeast. If you look at the population movement maps that the Census Bureau puts out periodically, everybody's moving to the Southeast. It's not just Nashville. It's not just, Huntsville. It's Texas and the southeastern states, right. Florida being the biggest one among them. There will still be problems in these because a deal is a deal on an individual basis, but you're going to have less problems in where the people are moving to than where they're moving from.
Mm-hmm.
So anyway, that's my opinion. It's going to be highly regionalized, but there will still be opportunities wherever you're looking. They may become hard to get. And those opportunities will be multifamily, and they will be retail, and they will be office buildings of that nature. So
that's I think that's a perfect way to get into our next segue of you being a CPA. And do you have any additional, like, let's see, what can we do as far as I guess 1031 exchanges? I know it can be done on multifamily projects, but I haven't personally done them, or I have personally heard of anyone doing them. I know residential, you can do them all day, but what are some benefits of doing a 1031 exchange, and what are some I guess some setbacks you can tell me about doing or tell the audience members as well about
Sure.
doing 1031 exchanges?
1031 exchange is one of the most powerful tax strategies you can employ, and it's been in the code since 1948. So it's out there, and a lot of people know about it. It's also referred to as a like-kind exchange, and it's been liberalized a little bit over the years, because when it originally came out, like-kind meant like for like. You couldn't expand asset classes. I mean, if you were trading a house, it had to be for another house. You couldn't go from a house to multifamily. So anyway, it's a lot easier than that now. So hugely powerful. And what it means, if you've got an asset that you've had for a while, it's got some real value to it, some unrealized gains, and you'd like to trade that for another asset, or you want to get rid of that one and move into another asset, then you can do what's called a like-kind exchange and defer the tax on the gain. Just say if you got $1 million property, your basis said it's $100,000, so you got a $900,000 unrealized gain on there. So if you take that value and you put it into the other one, you get full credit for your $1 million. You don't pay tax on the $900,000 gain. That gain gets deferred going forward. So hugely powerful. It's in concept, not very difficult to do, and it's become more and more popular since they added to the code the ability to use a third-party intermediary. So you don't have to it used to be you had to find the seller or find the buyer who wanted your property and you wanted theirs, and you actually swapped.
Yeah.
Very difficult to do. So now they allow you to have a third-party intermediary who essentially allows you to sell your property. They hold your cash, and then you take that cash and go buy something else with it. And since you never touch the cash, you get the tax deferred gain treatment. Once you have this middleman provision come in, they're hugely easier to do, much more popular. Again, easy in concept, fairly difficult in execution, because like in my business where we do syndicated investments, a like kind does not going from owning a piece of property outright to owning a security that owns property. So and we've done this a few times. So they have to come and be on the deed with us. And then when you're on the deed, so you're going from owner to owner, then when you're on the deed, then you have to work out, okay, now we're partners. Then you got to work out a good partnership agreement as to who does what. And that's, basically called a deed of trust agreement or something like that. Anyway, they can be somewhat complex to paper, to document, but the concept's there. And if the money is worth the hassle, then it's really no problem. Most sponsors that I know are willing to do that, probably for investments of hundreds of thousands, but maybe not the $50,000 entry level type thing.
Right.
So,
and so there you have it, folks. You got Stewart. He gave us a lot of tax saving strategies for 2023, and going into 2024, you can utilize the 1031 exchange. I had a brain fart, but it is a very powerful concept, especially if you're wanting to save on those capital gains. Like it is, I think is one of the most powerful concepts that you can do in the real estate sector. Okay, we're gonna go ahead and transition into the end and just, hey, do you have any parting words that you want to give to the audience members, Stewart? Because we're getting close on time here. We're getting close on time.
Sure. Again, thank you for the time. I guess my parting words and advice is when you're considering passively investing, know your sponsor. Take time to get to know them. Even if they're referred from a friend, you need to develop your own relationship and get to know them. Ask them about their track record. On our website, we've got a resource about how to evaluate your passive investment sponsor. About 100 questions in there that you can ask. Not all of them apply every time, but just things that you should think about as you're considering investing with someone, and ask them how they structure the deal. Because just as what we were talking about, one of the ways we structure our deals and we build our investments is we take in the reserves up front. So it's part of everybody's investment capital. So our deals will carry will carry themselves for 12 months. That's how much reserves that we keep on hand. So ask your sponsors about what happens when the unexpected happens. How are you positioned? Because you don't want their default go-to is I guess we got to do a capital call. And that's not to say that every sponsor out there doing a capital call is a bad operator. They are not. The world has changed massively in the last 2 years, which not very many people expected. I mean, hey, we've had 3 bank failures this year because of that very reason. And so just ask them how they're positioned for the unexpected. And the only real answer to that is, well, we've got reserves. And hopefully beyond that, your sponsor is well heeled enough to kick into the partnership, if things go really wonky, and hopefully a capital call is a last resort. But there's going to be more capital calls coming these years. So anyway, that's why I lean towards stabilized properties with good quality tenants. So
yes, that's awesome. I think I should have said this at the beginning. I am not a tax expert. You got a CPA right here in front of you, who's mainly focused on multifamily right now, but he is a CPA. If you don't have a CPA or a tax attorney or of that nature, get with your CPA, get with your financial advisor, let them advise you on anything in regards to your financial situation. Okay. So now that I got that out of the way, but I'm glad I had you on today, Stewart. I'm picking your brain and just getting the CPA side of things, and you also the investor side of things. So you get the best of both worlds. But it was great having you on. How can people connect with you?
You can go to stewartheath.com. Down here at the bottom of the screen, you can see how to spell my name. That'll take you ultimately to our website, which is harvardgrace.com. And all of my contact information is there. My Calendly link is there. Seriously, I'm open to taking appointments and calls with anybody. So use that link. And check out our resources. We've got more resources other than that checklist I just mentioned. We have new stuff that comes out every quarter. It's free. All we ask is for your email address. So anyway, would love to talk to anybody who's interested.
Awesome. I will make sure we include that in the show notes. Again, Stewart, thank you for coming on today. It's been a pleasure. I've learned a lot, and I'm sure the audience members have learned a lot and have some thinking and maybe tax saving strategies for the near future and for the rest of this year.
Thank you very much. I really appreciate you having me.
All right. Have a great one.